Where I think the off-putting part here is Trump, yes, we can lower interest rates, but it's not going to matter on the long end of the curve. Because if we continue at this deficit, the US is going to have to take on more and more debt with our current deficit, and with this big, beautiful bill going through, that's going to add to it. And so if you're an investor in the US Treasury, you're going to say, because of the amount of debt, I know it's going to continue going up, but if we're going to increase the rate that it's going to go up, I'm going to demand a higher premium for investing in this bond. So instead of a 4.5% on the 10-year Treasury, maybe you start demanding a 5.
Yeah.
Right. And then that's just going to, it's a snowball effect, because then the interest on the debt's going to go up, because we're not refinancing all of our US debt at a 1-year term, right? We're obviously doing it at 10, 20, and 30. And so investors have more influence on the long end of the curve than the Federal Reserve does, whereas the Federal Reserve has more influence on the short end of the curve than the market does. So for the Fed lowering interest rates, yeah, that's great, especially if you think that's going to have a parallel shift in the whole entire yield curve. But typically that's not how it works, right? And I'm more concerned that if we don't get a balanced budget in check, you're going to start to see a 10-year Treasury move higher above a 5%.